This is Barry Knapp with Ironside's Macroeconomics. It's Monday morning, June 3rd at 7:45 a.m. Mountain Time. This is the introductory version of our weekly audio and video summary of our weekly note. The weekly note was titled A Narrow Path, which is a reference to the three scenarios that we think are most probable for the markets over the course of the next quarter or two, which is either another real rate shock, a significant move higher in Treasury yields, 10s retesting 5%, or a growth scare where as soon as this Friday we get the unemployment rate to move above 4%, which exacerbates the concerns about consumption, consumer spending that is, that had the market under pressure Thursday and Friday after the GDP report and the personal income and spending report on Friday, until a fairly serious month-end buy program ramped to close on Friday. Remember, we ran the program trading business at Lehman Brothers back in the late 90s, and we're involved in many of those in our day, but that says really nothing about the overall direction of the markets. Or the third scenario that we just muddle along like we have for the first 5 months of this year, and between this path of higher rates, which have been grinding higher, and we expect them to continue to do so, all things equal, or a weakening of growth, long and variable lags finally kick in, the pressure on the banking system and small business sector finally manifest themselves in significantly weaker labor market and consumer spending data. So that was our, the basic premise of the note. That's what we went through in the first part of the note, was describing those two scenarios. We then dug in to some very interesting Fed speak. We're now, some might say, thankfully into the quiet period between now and the Fed meeting on the 12th. But there was some really interesting stuff that came out of Fed officials last week. The first was the debate on R-start, or the equilibrium policy rate, which is really a non-trivial or non-academic exercise at this point, because once the Fed does get started with any kind of easing, whether it's just a couple of cuts because inflation pressures ease a bit, or the economy does start to weaken and they start to cut, we're going to immediately start to consider where the path is going to. Are we going all the way back to 2.5%, where the Fed thinks the neutral policy rate is actually 2.6, and we're going to get updated figures on that, which will probably be a little bit higher, or will they end up stopping at 4, as we expect? So New York Fed President Williams, who's written one of the models all the way back in 2001 that tries to estimate where this equilibrium policy rate is. He still thinks factors like productivity and demographics means it's still fairly low, whereas Fed Governor Waller the previous week, our note last week was titled Waller's World, thinks that those are not factors that drove that rate lower during the 2010s. And doesn't think they're having a real negative impact right now. You had former New York Fed President Dudley saying he thinks that rate's much higher. Lori Logan, who's the president of the Dallas Fed, who worked for both Dudley and Williams, saying she thinks it's higher. So this is a real important debate. And as a full subscriber, you'd get all of our gory details on our perspective on this. We think that rate is substantially higher. There were also some developments on the final maturity profile of the Fed's portfolio. Fed Governor Bowman gave a speech in Japan a week ago that said she thinks that the Fed should be reducing the duration of their portfolio, concentrating their holdings into shorter term securities, something we are advocating for. We call it the bills only policy. They're unlikely to do that anytime soon, as they're trying to see what the impact of slowing QT is going to be on liquidity. They're worried about repo rate spikes, but that influence of the Fed's holdings on longer term rates is really distorting the capital allocation process. And we think that will be the final destination. It's just going to take some time to get there. So we then went on to talk about GDP reports and how underlying domestic demand is still pretty strong. Investment is okay, particularly in software R&D. It's starting to recover. But, there is evidence that goods demand in particular is weak. And that led us into, a bit of a discussion of the labor market, but really a change in our allocation. We're reducing our exposure to the consumer discretionary sector. It's underperformed as rates have gone up through the course of this year. And if we have a growth scare, we think that sector will lead the way down. That's typically what happens in, a Fed policy related correction, a growth scare, or a recession. And so if we have the growth scare scenario, we'll have an opportunity to re-engage in that sector. But for now, that takes our cash holdings up to 20%, our aggregate portfolio risk to a market risk from about 100 basis points above the market, and puts us in a position to take advantage of a pullback should one develop. So as a full subscriber, you'd get to see all the details about all this. So please consider becoming one. If you need a trial, let us know. We're happy to accommodate. Barry Knapp from Ironsides. Have a good week. Thanks, everyone. And it's payroll week. It's a big deal. Bye.